Corporate Finance Core Topic 2, Forecasting Financials and Cash Flows, Learning Objective number 2. We're going to evaluate external funds needed, EFN, and capital structure decisions. In other words, in the first section, we did a first pass of forecasting a pro forma financial statement, a forward-looking financial statement. And in this topic, we're going to focus on doing the second and third pass where we think about the financing decisions and getting the balance sheet to balance. So I'm going to go back to our spreadsheet. And so here's the end of our first pass. Our first pass, we had a forecasted external funds needed. We look right down here of 153.36. And so let's do a couple scenarios. Let's say, how are we going to close this gap? We have excess assets over liabilities and equity. One way is to simply just issue $153.36 of common stock. So in this spreadsheet, if I look at common stock, now this common stock is both the par amount and and the excess capital paid in par over par. So you can think of this as the total value of the common stock. And notice the formula is last year's value plus this cell, E18. So in that cell, I can make an assumption that we just issue $153.36 of stock. And there you go. The balance sheet is now perfectly balanced. And let's see the effects this had on the organization. There's no impact to the income statement. It really is just increasing this one number of common stock to get the balance sheet to balance. However, look what it implies. If we had 100 shares outstanding last year and you issue $153 in stock and the stock price is $15, if I take 153 over $15 a share, I must have to issue 10 more shares. So the shares go from 100 shares to 110 shares. And then my EPS now, profit over or net income divided by number of shares, now only got about, what is that, about a 16 or so % growth in EPS with a 20% growth in sales. That's because my shares are growing by 10%. So, and also if you look at my ROE is actually falling. Let's think about what's going on there. Why is my ROE, my biggest metric that managers are maybe evaluated on, my asset turnover is remaining constant. I'm forecasting that I do no better at turning assets into sales. My profit margin went up a little bit. However, the reason I'm doing poorly, or reduction in ROE, is because my leverage is going down. In other words, I'm using more and more stock to finance my assets, which is reducing my leverage. So actually, this is an interesting solution. My profit's going down, but also my risk levels are going down because I have less debt as a % of my financing. So that's kind of a hard one to evaluate. It's a safer company and a little less profitable for shareholders. So let's look at another scenario. We're going to talk about, well, if I want to issue stock, why don't I just maybe eliminate the dividend first? So let's go back here to the spreadsheet. I'm going to put 0 back here. And you might say that, well, before issuing more stock, maybe I should turn the payout ratio to 0. In other words, I'm going to plow back 100% of profits into retained earnings. So now I only need $121 of financing. Okay, so now if I can just issue $121.15 instead of $153, and that'll balance the balance sheet. However, the market tends to react very poorly to reducing dividends, so that's something you may not want to do, or at least the management may really consider before they reduce their dividend. So let's look at another scenario. What if we just finance the difference all with debt? Okay, so back to here, I'm going to set that payout ratio to 25%, which implies that 75% of profits go back into retained earnings. I have that 153 external fund needed. So what if I just plug in, we're going to issue another 153.36 in debt. That's going to show up here. The extra 153 is going to show up right here because it's long-term debt is prior year's level plus this change in debt. However, look what happened. it didn't balance my balance sheet. Why? Well, it's off by 690. So let's do it again. I'm off by 153. I'm going to put the 153 in change of debt. But when I do that, my interest expense goes up. My interest expense goes up, my profit goes down, and then my retained earnings goes down. So what happened is this retained earnings fell. So I need to actually finance that change. So I'm going to take that, I'm going to add the 690 because of the reduction in or increase in interest expense, and see if that plugs it. Oh, really close. Now I'm off by 31 cents. Why? Because when I issued six more dollars in debt, I'm going to pay interest on that $6. So I need to finance that 31 cents. Oh, now I'm off by 2 cents because the 31 cents is going to generate interest. So I'm going to add the 2 cents. So it looks at it 160.59 is the change in debt to get the balance sheet to balance. Now another way to do this, instead of this iterative process, is to go to Data, What If, Goal Seek, set external funds needed to a value of 0 by changing the debt balance. And there's the 160.59. Hit OK. So that's another way of doing it. It's using Excel's Goal Seek tool. So that's another way. It's 100% financing using debt. Let's talk about a mixed plan. What if we used 50% debt and 50% equity? Okay, so let's go back and try that. I'm going to change this back to 0. So I'm going to change these two, the debt and the common stock. And I need 153, so I'm going to say 153.36 times 0.5 and put that there. So I'm going to issue $76 of debt and equity. However, the debt is going to create more interest expense, which is going to lower my retained earnings. So I got to add 345. So plus 3.45, and that's going to be financed half with debt, half with equity. So I'll put 0.5 there, and then I'll copy that formula down. Oh, I'm off by 8 cents. I'm going to add the 8 cents is going to be financed half with debt, half with equity. Copy that down. And there we go. It looks like 78.45. If I issue 78.45 of debt and equity, I now have balanced my balance sheet. I've financed the assets, and you can see here's the total level here. It looks like ROEs are pretty constant. I am reducing my leverage, but I did increase my profit margin a bit, and the net effect is ROE is increasing. EPS looks like it's up about 17% or so, from 102 to 118, with that extra 5 shares issued. So that is our solution using the first, second, and third pass, assuming that we use those 4 different scenarios. Let's talk a little bit about the financing, the financial forecasts and external funds needed. In the prior example, if management could have financed the external funds needed, that 153, by doing a number of things. They could pay a smaller dividend, that would increase L&E. They could issue a stock, that increases L&E. They could issue debt or bank loans. However, one thing we didn't do is maybe they could have decreased the cash balance. In other words, use the cash the company currently has to finance it. So think about how that would affect the spreadsheet. If I just reduce this cash value, that would drop the 1620, which would also reduce our EFN. All right, but however, you can only do that if you have excess cash. What if that cash is actually needed for the cash registers and just going to manage the inflows and outflows? So you have to think about what is the level of cash that your business needs. The other thing you could have done, we haven't really played with this, but maybe later we'll look at this, is buy less fixed assets. Maybe I can't do 20% growth and I don't want to go out and raise more stock or issue more debt. So I could just reduce sales, which would then reduce fixed assets. So that's one way of doing it. Now, in this last example, what if the numbers just turned out to be negative external funds needed. In other words, the liability and equity actually exceeded assets. That means you have extra financing, too much financing. So what you could have done is just paid a larger dividend, reduced retained earnings. You could have repurchased stock or paid down debt. These are good things, right? You could increase your cash balance, just hold more cash, increasing your asset. Or if you had excess money, why not buy more fixed assets? And then maybe think about, well, maybe I should increase my sales forecast since I'm going to have excess capacity. So these are ways of thinking about financing the organization. But it's also just thinking about, what is my strategy for this organization? Can we sustain that level of sales, or given that level of sales growth, are we going to be able to issue, stock or debt at appropriate levels? Let's just do one more scenario before we finish off this section. And let's just look at, it's a common thing to do in forecasting. What if there was no sales growth? Well, what would things look like? So all I need to do is I'm going to change this back to 0, 0. I'm going to set sales growth to 0. Notice there's a link here that short-term assets and liabilities are also equal to 0. And then what I have here is I'm forecasting, if we don't grow sales at all, we're going to have an extra $76 in financing. So that's a common thing to do, is kind of see the effects of just a no growth scenario. And then maybe what I might do with that is thinking about, well, if I have excess financing, maybe I should start thinking about getting a sales growth higher to use some of this extra money and see the effects on my financials. So in this topic, we evaluated external funds needed and capital structure, and doing the second and third passes of our pro forma forecasted financial statements, and thinking carefully about how I'm going to finance it.